Hi, Professor. My name is Amrit. So I'm going to talk about Wolfspeed bankruptcy exit in September 2025, in which I'm going to introduce the main themes, which are financial risk, debt-heavy growth, and the role of CAPM in capitalizing, analyzing investor perceptions. So let's talk about the executive summary. In this presentation, we will look at the Wolfspeed, a semiconductor company, and went through bankruptcy but quickly existed in a restructured balance sheet. The event is significant because Wolfspeed is a leader in silicon carbide semiconductor, a technology vital for electrical vehicles and renewable energy. The Chapter 11 exit in September 2025 cuts its debt by about 70% and also reduced the interest rates cost by 60%. However, shareholders lost most of their values while creditors gained equity. The market reacted positively with shares jumping over 25% after the announcement. The case gives us insight into leverage, restructuring, and how capital market reacts to the risk. So let's talk about company's background a little bit. Wolfspeed is not just any chip company, it specializes in silicon carbide chips, which are crucial for electrical vehicles and renewable energy because they handle high power more efficiently than traditional silicon. But producing these chips require very expensive manufacturing facilities, known as fabs, and heavy R&D. Wolfspeed chose to fund this aggressive expensive mainly through borrowing, which created a highly leveraged balance sheet. So here are some of the Wolfspeed walk back, which industries they in which industries their silicon carbide chips they are using, which is a EV fast charging, grid infrastructure, solar and renewable energy, power supplies, also industrial power, UPS, induction heating and welding. So let's talk about timeline of events. Timeline of events is really important. At the start of 2025, Wolfspeed was really struggling to refinance debt due to high interest rates and weak cash flow. But by the mid-year, it formally entered Chapter 11, which allows the company to restructure while continuing operations. By September, Wolfspeed emerged from bankruptcy because it had negotiated a pre-arranged plan with creditors. This quick turnaround shows the efficiency of pre-packaged bankruptcy in limiting business disruptions. So let's talk about what happened. And Wall Street, more than $2 billion debt was simply too large relative to its cash generation. Bankruptcy court approved a restructuring plan that slashed debt by 70%. This also reduced annual interest expenses by more than half, giving the company breathing room, which is about 60%. But the trade off was brutal. For existing shareholders, their equity was either diluted heavily or lost entirely. In essence, creditors became the new owners. So, why it happened? On the left side, the pie chart shows financial causes. The biggest share, about the third, comes from high leverage from expansion. Wall Street borrowed heavily to build new manufacturing capacity before revenues were stable. Another major factor is the high fixed cost of fabs. Semiconductor plants are very expensive to run and they require high volume of break-even. Delayed profitability added further pressure because Wolfspeed new silicon carbide projects were not yet generating strong cash flows. Finally, rising interest cost means the servicing its large debt became harder as interest rate increased globally. On the right side, the bar chart shows external factors that amplify the crisis. A slowdown in semiconductor demand reduced expected revenues, supply chain disruptions, drops of input cost, and caused delays. Highly global interest rates made refinancing debt much more expensive, and risk averse investors were less willing to provide new financing to highly leveraged companies. Together, these financial and external factors created a perfect storm. Even though Wolfspeed has strong long term potential in silicon carbide technology, its financial structure and the external environment combined to push it into bankruptcy. What are the market impacts? So let's talk about some market impacts. Bankruptcy shook investors' confidence across the silicon carbide semiconductor industry. The term impacts are Wall Street suppliers, partners, and EV customers face uncertainty. But the long term impacts are restructuring reduced risk and the market prices stronger survival chances. Shares rebounded post-exit, showing the market value clean balance sheet even if equity was diluted. So, they are using CAPM model to conclude like how to understand their financial statements. So let's talk about a CAPM model. So, Wall Street bankruptcy shifted investors' perception of risk using the CAPM model. Before the crisis, we can see with the beta of 1.3 and market premium of 5%, Wolfspeed required return on equity was just 9.5%. But during the bankruptcy, perceived risk shot up and beta rose to 2.0 while the market premium to 7%. That raised the cost of equity to 17%, which is really high and which is like high approximately half of the percentage of the pre-crisis. Investors demand nearly double the return to hold Wall Street stock. For the company, that meant lower valuation and much more difficult raising funds. CAPM helps companies put number on how crisis change the cost of capital and investor sentiments. So what are the observations? So there are some key observations that is high leverage in cyclical capital intensive industries is dangerous. External shocks like interest rate hikes or demand slowdowns can turn stress into collapse. But bankruptcy usually wipes out shareholders, but creditors may recover through the debt from equity swaps. Finally, CAPM help us how investor perceptions of risk changes and how that translates directly into cost of capital and market value. Here is a discussion question like how should companies balance aggressive growth with financial prudence to avoid Wall Street's mistakes? Here are some references and thank you so much for your listening.